Hello and welcome to another episode of the Minor Issues Podcast. I'm Mark Thornton at the Mises Institute. Well, our annual contest this year has really been exciting, where we've looking at your predictions for how well Bitcoin is going to do relative to how the price of gold is doing. And Bitcoin is up over 20% this year so far, but gold is up 60% so far early in the week. So far, gold is pretty far ahead of Bitcoin at this point in time. I'm sure there's going to be more fireworks to come by the end of the year and the end of the contest. Well, this weekend, the Mises Institute is on the road in Delray Beach, Florida, for its annual Supporter Summit. So in lieu of a full episode, I want to show you a recent show that I was on, the Liberty and Finance show over the weekend. And they brought me on to talk about the pivotal level of silver prices at $50 per ounce. And it was hanging right there as I went on the show. I talked about the real meaning of that $50 level. We also went back and looked at my so-called prediction for the gold-silver price ratio and how well that's been working out so far this year, which has been really great and with more good things to come, I think, there. And then they asked me about what's really going on in the economy. What are the real black swans that we need to be on the lookout for by the end of this year. So we talked about that, what could potentially do in the stock market. And then they also asked me about the current war status in the global economy, new developments in that area. So it's a great show. It's a great interview show. I highly recommend it on a regular basis. They have some really good guests on there. And the audience seems to appreciate me and Mises people in general. So I encourage you to listen to this podcast episode of my interview with the Liberty and Finance show. And thank you for listening to this episode of the Minor Issues Podcast. I'll be back next week with another episode.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Dr. Mark Thornton from the Mises Institute. Dr. Thornton, thank you so much for joining us today.
It's great to be here today.
Well, it's great to have you. Last time we had you on, my father Dunnigan interviewed you about how we are on the road to hyperinflation. And we can see this across the board, especially in the last few years in metals prices, as metals prices have doubled for both gold and silver, which is pretty shocking. And right now, as we're recording this, silver is above its 1980 high, above its 2011 high. It's above $50 an ounce, which is this incredible price barrier that has, for 45 years, the silver has failed to rise above that price. Your take on the significance of this, and what does it mean, maybe if we look again at what does it mean for the US dollar, that silver is rising so dramatically so fast?
Well, it is an historical level, but it's basically a psychological barrier for most people, or even not even most people really. But if you look at $50 back in 1980, you have to realize that those dollars have depreciated by 70 or 80%. And so $50 back then does not mean $50 today. It's much, much lower. And so really it's a psychological barrier. There may be somebody out there who paid $50 a long time ago and they want to get out of silver right now. But it's really just that. I don't expect this to become an impenetrable barrier to the progress of silver prices, even really in the medium term. I think this is just a short stopping point and that we'll get through that price just given inflation over time and given that they're still printing and they're still borrowing and they're still spending in Washington, D.C. So we have expectations that long run silver prices are headed higher, maybe much higher. And so I really see this as just a psychological barrier. Traders are probably using it to take profits. And that kind of thing. But I suspect that in a couple of years, we'll look back on that, look back on this day, and we might not even be able to see the price variation that we've seen the last couple of days in the charts. Now, there's eventually going to be some big time pullbacks in this market. As you said, silver's up 100%. It's up 20% this last 30 days. So it's going up very rapidly. And, if you look at any market, you're going to see, some noticeable pullbacks. Whether or not that occurs here is an open question. But, you've got to expect that thing in any commodity market.
When we're looking at precious metals, I mean, as you mentioned, it is a psychological barrier, not even a real high, right? It's a nominal high, but compared to the dollars in 1980, the dollar, as you mentioned, has lost, 70 to 90 or so % of its value. So when it comes to, and if you look at what gold has done, right, it's about 5 times its 1980 price at the moment, but silver is still just about at that price. So I think people should reflect on that and say, well, actually, at the moment, silver is probably still pretty cheap comparatively.
That's right. And I think that is true. And I think that there is a question mark in this marketplace as to what happened between 1980 and 2011 and the present. Michael Oliver is described it as a big mistake. And so I'm trying to piece together some of the fundamental structural reasons why that was the case. And I think there are some noticeable possibilities here. Of course, much of the silver demand in 1980 was due to photography and x-rays and that kind of thing. And of course, we know that technology displaced the use of silver in what was its main application. And so there was a downdraft in the demand for silver for many, many years. And of course, we did have much lower CPI rates there for quite a bit. Interest rates and inflation rates collapsed in 1981. And we saw a very multi-decade long process of lower CPI and lower price inflation and lower interest rates over a very long period of time. So that's definitely contributing to the fundamental structural reasons. And then, of course, there's been a big increase in the price level for industrial metals across the board. So things like lead and zinc and copper and so forth. And as I've pointed out here in the past, and I want to develop that a little bit more, and on my own Minor Issues podcast, that silver is mined and found and produced much as a byproduct of these industrial metals. And so people will go in and set up a copper mine or a zinc mine or a lead mine, and the main product that they get out is copper, zinc, and lead, but they also get out silver. So as those industrial metals expanded after 1980, and the price of those metals rose, and they're much higher now today, those industries as a group expanded. And so the supply of silver from those industries also expanded from their historical levels. And so, it's reasons like that that I want to try to eventually completely explain why silver has not kept up with the other metals, with in particular gold. Of course, gold and silver move in tandem, but not perfectly so. And there has been this divergence in trends where gold has done much better than silver. And of course, as we all know, the reason gold has done so much better in recent times is because central banks around the world have been adding to their gold reserves. And so there's been a big increase in the demand for gold that has not bled over into the demand for silver, because silver is just, it doesn't seem that way for us minor league stackers. That doesn't seem to hold that much volume. But if you're buying $1 billion worth of silver, it takes up a lot more space than $1 billion worth of gold. So there's a lot of fundamental structural reasons. And I see, in terms of the momentum of price, I see that reversing itself in the future.
Now, when we first had you on, the gold-silver ratio was over 100 to 1. And in subsequent episodes, we've seen the gold-silver ratio fall to the 80s, mid-80s to 1. Right now, as we speak, it's really testing that $80 level. It's just under, 80 to 1 level. It's just under 80 to 1, or about 79 to 1 right now. Your take on this, as we see silver outperforming, you say in the last few years, gold has outperformed. But at the moment, it seems like, over the last couple months, as the ratio has fallen, silver has outperformed. And often in bull markets, we do see silver kind of play catch up. Do you think that's what we're seeing right now?
Well, yes, there's no doubt that individuals and small investors are catching on. And so they're going out there, and industrial users have been adding to their inventories. I guess I first contemplated that type of gold silver ratio exchange when it was at 104. And then by the time I ran through the numbers and we talked about it on air, it was 100 to 1. It's since fallen to 80 to 1. That means if you traded 1 ounce of gold for 33 ounces of, 100 ounces of silver, with the ratio falling to 80, if the price of gold hadn't gone up at all, that means you would have earned a 33% profit on that trade. And of course, because you're just trading metals, you're not putting any new money forward. And if you look at the profits on the silver that you would have received versus the price of gold, and given that the price of gold has also gone up, that you're basically making about 50% on that trade. And so it was a profitable trade, and I expect that the gold silver ratio is going to fall even more. I mean, and I think a lot of people in the marketplace are expecting the ratio to decline. And so with a standard investment time horizon of a few years, I think that it wouldn't be outrageous for the gold silver price ratio to fall to something like 50. And then, of course, if you took my hyperinflation scenario seriously, or if it actually happened, then we would probably expect the gold silver ratio to fall below 20. And you would start to see people actually using silver in day-to-day transactions. And so there would be a greatly enhanced demand for silver. Now, of course, we don't want that to happen. We don't want hyperinflation. It's the most destructive thing that government can do to society outside of war. And so we definitely don't want that to happen, but that's probably what would happen if we got into that hyperinflation stage where the government was just printing money to pay for its operations, to roll over the debt, so on and so forth, and people found themselves not able to hold money. I mean, if you held money, it would just completely evaporate in your hands. And so people would want to be dumping their money. They would want to be spending their money, and the value of money would depreciate extremely rapidly. I mean, a standard hyperinflation is where the consumer price index is going up by more than 50% per month. And so you obviously don't want to hold money under those circumstances. And so eventually people would transition over to, wages paid in silver and day-to-day transactions in silver. And so obviously the demand for silver would increase. The price of silver would increase relative to gold, which isn't good for day-to-day transactions. And so you would see an extremely low gold-silver ratio, probably definitely less than 20 or maybe even less.
Now, focusing on some of the drivers of precious metals right now, last time we had you on, you were talking a lot about the really the geopolitical drivers. And one of the things I did want to talk with you about is, I guess, the geopolitical conflicts around the world. Obviously, we're seeing a sort of it seems like a sort of positive peace deal with respect to the Israel conflict. And then we're also seeing maybe some escalation in Venezuela by the U.S. Your perspective on the current geopolitical situation and how that is impacting precious metal prices?
Well, I try to stay optimistic about this question above all else, but I applaud the idea that at least the people on the West Bank are getting food and water and so forth, and that a peace deal of some sort looks like it's being engineered and is forthcoming. And so we all have to applaud that action, that de-escalation in the Middle East, which is, of course, a hotbed for international conflict. But the U.S. is still in military conflict around the world. We have sanctions all over the place, particularly against Russia, but, President Trump has been using these tariffs as a punitive sanction-like tool on a regular basis. And so sanctions are out there, and even the trade war is a very disconcerting part of this militarization of foreign policy. And the tariffs are a big part of that. I mean, slapping tariffs on these other countries, that's obviously not taken as a positive. That's taken as a negative. And we've been doing that to just about everybody around the world, our neighbors in Mexico and Canada, our friends in Europe, India, that, we've been trying to get along with for quite some time, and to keep them out of the communist China and Russia, keeping them out of those orbits. And what we're ended up doing is bringing them closer into the Chinese and Russian orbits of political influence. And so in total, we're definitely escalating war measures across the globe, really. We have a declining number of friendly relations and an escalating number of hostile relations with other countries. And so it's a very dark time actually out there. And that's one reason why, of course, people are investing in gold and silver, because it's the ultimate protective device. It's the ultimate personal fire extinguisher device to have on hand to take care of the contingencies. Now, what President Trump has been doing in Venezuela, of course, the Venezuela is very, very bad off. They have a Marxist, communist, socialist dictator in charge down there. It's an awful situation for the local people. But of course, President Trump has used the military to blow up a couple of small boats charged sort of with drug trafficking violations. But everybody knows basically that they're making preparatory steps down in Venezuela in the northern tier of South America for military type actions. And, our oil companies are interested in taking advantage of the situation of the oil reserves of Venezuela, but really the whole region, the oil reserves on land and the oil reserves and discoveries out in the water. And so I'm not sure what's going to happen down there, but the moves that we've been making so far are, steps towards war. And I don't see this as part of that grander military issue. It seems like it's more of something that a politician would do to bolster their chances in an upcoming election where, you fire some weapons and some bombs and you have maybe a takeover of a third world dictator as a way to bolster your political chances in an upcoming election, really, rather than as part of an affront to the Russians and the Chinese and the Iranians and so forth. So not sure exactly what to make of that, but again, it's an escalation, a destabilization of the international accord.
And last time also we had you on, you were talking about possible black swans that could really shock the market. And it's interesting because a lot of this, a black swan by definition, right, is unpredictable, right? But a lot of these things are predictable. And we do see, as you mentioned, just the continued escalation of geopolitical conflicts around the world. And we're seeing really concerning developments with respect to the economy. What are some other things that could maybe shock the mainstream, but that you're looking at right now that could be really disastrous for the economy?
Well, it really is hard to predict because when the Fed pumps money in and they buy up government debt and they expand the money supply and they lower interest rates, they really set off a cascade of negative effects throughout the economy: overinvestment, malinvestment, over-indebtedness. And so that's the general phenomenon. And so it's hard to pick what's going to be the black swan, what's going to be the first thing to crater that's going to bring everything else down. So, what's the section of the stock market that's going to collapse and bring all stocks down with it? Is it going to be artificial intelligence that seems to be in a runaway boom? It really is hard to tell what is going to break first. One thing that I have my eye on is the private equity section of investments, because private equity, just by definition, means it's been taken off of the market. We don't have day-to-day market-determined prices for those assets. And so there's a lot of lack of information. There's a lack of transparency there. We have investors who have been taking stakes in companies that aren't traded. And so we don't really know what the valuations of those are, and even the investors themselves. And they have a hard time getting out of those investments. So we don't know when there's going to be a run for the exits and whether or not private equity is going to be that source. But private equity is a prime candidate. If those companies start to falter and not be able to make their bond payments, and that's part of the whole private equity thing, is you buy a company, you take it off the market, you fill it full of debt, and then you sell it to somebody for a big profit, right? And so not being able to pay that debt, if private equity firms, not the people that put together the deals, but the deals themselves, if they start to falter, that could cascade, and we could, trace that all back to the Fed's easy money policy. So that's something I'm very, very concerned about is, the situation with private equity type arrangements in the marketplace. That's really something that is easy to keep away from investors' attention precisely because it is private equity. And so private equity and of course, artificial intelligence and everything that has to do with that, the great data centers that they're building. There's classic signs there of the Austrian business cycle theory, where they're trying to build out this brand new industry and this high-tech industry, and they're putting strains everywhere on the system, including our very own electrical prices. They're driving up the price of electricity in states across the union. Wherever they're building, they're anticipating using massive amounts of electricity, and that's going to drive up the price of electricity because of the regulated nature of that marketplace and the fact that energy sources to make electricity, all of our investments have taken place in things like solar and wind and stuff, and that's really not great sources of electricity for a data center, which needs that power 24/7, 365. And so, I'm just investigating right now several of these possible black swans, and the one thing that we can follow the trail is the Fed increasing the money supply, engendering new investments, and then what happens as a result of these new investments and when are they going to break?
It is so interesting how just the manipulation of the currency supply can create all these distortions, right? When people are not when you don't have a stable currency, or when you don't have this a place to put your funds and know that they're going to be, worth the same 10, 20 years down the road, it really leads to a lot of malinvestment, a lot of speculation out there. And it's just a completely, I guess, distorted economy, which then, as you mentioned, even in some areas like private equity, we really don't know the truth behind right now, and there could be a lot of surprises coming soon.
Yeah, like to a power bill in your mailbox in the future. So those kind of surprises are actually very traceable if you understand economic theory and the Austrian theory of the business cycle and what the Fed is actually doing to our economy. Now, eventually, it all comes together in the CPI and, just general increases in prices. We get the general increases in prices, but the people who first get the money, they're making all the wealth, they're making all the profits, they're seeing stock prices skyrocket to the moon. So the first feeders of the Fed's, grand giveaway, they have the tremendous benefits. But the average person, middle class out there in America, they end up paying the higher prices of goods and services. And I see, one of the few ways to protect yourself against that is to invest in inflation hedges, such as gold and silver.
Certainly. And if our viewers are interested in learning more, we'll put a link in the description of this video to your Minor Issues podcast. Did you have any last thoughts for our viewers?
Yeah, well, I have some exciting, things for the Minor Issues podcast, and it's MINOR. I mean, I talk a lot about precious metals and various things to do with those sectors, but I talk about all sorts of things. And it's different every week. And the reason it's called minor issues is because I try to deal with issues that are not dealt with in the mainstream media. So these are things that I try to present in about less than 10 minutes of things that just simply aren't addressed. They're considered by the mainstream press to be minor issues, but I think they're some of the most important learning tools that you can get in a 10-minute podcast. It comes out on Saturday morning.
Fantastic. And I know you gave me a little hint of what tomorrow's episode is going to be, so that should be quite interesting. I'll definitely put a link to it when it's available in the description of this video, and I encourage everyone to check it out. So really appreciate your time today, Dr. Thornton. You have a good day, and God bless.
Thank you.